Let us now look at Article 10, Paragraph 2 of the India-USA Treaty. And this deals with the right of the source state, in our example, India, to tax dividend. Now, if you remember, Article 10, Paragraph 1 said that the dividend which arises, may be taxed in the state of residence, which means that the state of residence has a right to tax that dividend. But what about the state of source? However, such dividends may also be taxed, which means additionally, in the contracting state of which the company paying the dividend is a resident. So if the dividend is being declared by a company which is a resident of India, then India also has a right to tax such dividend, and according to the laws of that state, which means according to the Indian laws. So if the Indian law provide for tax rate of 30%, that is what is going to apply. If they provide for 40%, that is what is going to apply, right? That's what is said by the first limb. But this is subject to certain exceptions. And what is the exceptions? The exception says that but if the beneficial owner of the dividends is a resident of the other contracting state, resident as per Article 4, other contracting state, US. So if the beneficial owner of dividends is a resident of United States, the tax so charged shall not exceed. Now, what is the meaning of tax over here? Generally, if you see, the term tax is defined in Article 3 relating to definitions. Therefore, when it says that the tax will not exceed this amount, you need to go back and look at Article 3 if the definition of tax there includes the surcharge which is applicable in India. If the definition of tax includes the surcharge which is applicable in India, then that gross rate is going to be what is prescribed here. 15% of the gross amount of dividend if the beneficial owner is a company which owns at least 10% of the voting stock of the company paying the dividend. There are a few points which one should keep in mind. 15% is applicable on the gross amount of dividend, right? Second is the beneficial owner, which is the recipient, has to be a company, right? And which company? A company which owns at least 10% of the voting stock of the company paying dividend. Now here the question which comes up is, if the company or the recipient is a partnership firm which is treated as a company as per the laws in the state of residence, will it also be entitled to the benefit over here? And the answer to that is no. Whether or not it is treated as a company as per the local law doesn't make a difference if it is a partnership firm, right? The second is the 10% ownership as per the India-US treaty has to be of the voting stock. Now, voting stock would typically refer to the equity share capital. In some treaties, you may find that instead of voting stock, the word used is capital, which means that the ownership has to be of 10% of the capital, and capital, when we look at, will mean the share capital, equity, preference, etc., along with the reserves, right, of all classes should be considered. And if you're not falling in this case, 25% of the gross amount of dividend in all other cases, which means for company owning less than 10% plus all other forms of assessee, the rate of tax will be 25%, right? This paragraph shall not affect the taxation of the company in respect of the profits out of which the dividends are paid. So if the Indian company has some business profits on which it pays a corporate tax of 30%, the payment of that tax is not going to be impacted by the provision of this particular article. Now, one point which I want to make here, which is kind of a generic point in nature, is that even though these dividends that we are referring to may be exempt from tax in the state of residence, what we have discussed here will still apply. Another point worth noting here is that the ownership criteria referred here is of 10% of the voting stock. In some of the treaty, they may construe this further to say that the ownership has to be direct. So the ownership has to be direct, which means the company which is receiving dividend itself should own 10% in the Indian company, right? So what are some of the salient features? It deals with the right of the source state to tax, the beneficial ownership of the recipient in the other contracting state should be established. That's where the reduced rate of taxation is available. If the shareholding is greater than specified percentage, which was 10% in this example, the reduced particular percentage of tax applies. Concession is available even if the dividend is exempt in the resident state, which means that if the rate of taxation is 15% for a beneficial owner, that 15% would continue to apply irrespective of the fact that in the state of residence this dividend is exempt from tax. And states can decide whether and in what manner the dividend are to be taxed. But if the state of source levies certain taxes, the credit for that tax has to be given by the state of residence in accordance with the provision of Article 20. We had looked at the beneficial ownership, that if the beneficial ownership exists, then the reduced rate of taxation would apply. What is the meaning of beneficial ownership? This term is actually not defined in the treaty. But let us try and see some examples to understand this a bit more. Suppose the Indian company makes over a payment of dividend to F1, which is a foreign company, resident of country X. What F1 does is, the moment it gets, let's say, $100 from the Indian company as dividend, it immediately upstreams this entire $100 to its beneficial owner, which is a resident of country Y. F1 did not have any right to use this dividend income in any manner whatsoever. The moment it receives, it has an obligation to make it over to the beneficial owner. In such a case, the reduced taxation would not apply. Second is, if an Indian company makes over a payment of dividend to foreign company, F1, which is a resident of country X. Again, F1 also is not the beneficial owner. The beneficial owner is someone else, but the difference is that instead of being a resident of a different country, here the beneficial owner himself is a resident of country X. In such a case, the provision of the Indian company, or India and country X treaty can be considered as applicable.